In this video, I'm going to explain what is called a basis trade, and this strategy can be used in traditional markets and crypto markets. And this is a strategy where you don't have to have directional exposure to a market, that is, make money when the market goes up or goes down, but instead you're making money when the market can go sideways or go up or go down. Don't worry if you're a beginner and you don't understand any of this terminology. I'm going to go through it in this video so you understand. Just to give you an idea of this strategy and what you can earn and how your portfolio can grow with no directional exposure to the market, here's a $10,000 portfolio, 40% APR, which is basically 40% annualized return on your money, and compounded every 8 hours. So that takes you, just over $14,000 in 1 year. Over 4 years, that same strategy can basically 3.5 times your portfolio if you play it right. So let's first start off with what is a basis trade. A basis trade is where the funding rate is our profit, or the basis that exists between two different products, and we'll go into this in a minute. The spread is our enemy. It's important to note that this funding rate fluctuates with time and how the market moves, different narrative, different conditions. There's no directional risk once you enter a basis trade, but it's definitely not a passive strategy, so you must be aware of that. It's not just set the trade up, forget about it. You have to actively manage a basis trade. Why would you have a basis trade open in the first place? You might want to diversify your exposure to the market and have some directional plays, like being long Bitcoin and expecting price to go up, but also some of your portfolio you might just want to have sit there and have a return on that while the market could go sideways or even down. So it doesn't give you a directional exposure, and you can take advantage of higher interest rates or APRs than you would just lending stable coins or sitting your money in a traditional savings account. We saw when the market really heated up into the ETF decision, BTC contracts, which are very, very liquid, were paying 40%, a very big opportunity that you can take advantage of with decent capital. And like any investment or any venture into the markets, there's no free lunch. There's always risks. So the risks of a basis trade are your counterparty risk. Of course, you're conducting these trades on an exchange, and that exchange, just like FTX or other brokers, can go down and go bankrupt and your money's gone. So that's one risk you must be aware of. The likelihood of it happening is quite low, but it does happen, as we've seen over the last couple of years. The spread on the entry and the exit. So with these positions, we'll go through it in a minute, but you're entering a long and a short to give you a net neutral or delta neutral exposure to the market with no exposure to the direction of price going up or down. So entering a short position and a long position, you might not enter at exactly the same price on each leg of the trade. The spread can eat into your profit quite significantly. We've spoken about the funding fluctuations, the funding rate. We'll learn exactly what the funding rate is and what it means, but that funding rate that's paid on being in a position like this fluctuates. And of course, if that goes against you, you can start to have a negative expectation of profit on that position. So you have to be aware of that too. Also, the collateral requirements that you must keep on these exchanges is also a risk, and you're at risk of getting liquidated or margin called if you don't have sufficient funds to keep this trade open. You can conduct basis trades with leverage to amplify those gains, but you must be aware that there's that risk of being margin called, just like you would with a futures trade or any other type of trade. And the fees, of course, entering and exiting trades, there's fees, and that's going to eat up your profit. The profit is basically the basis or the funding rate minus the fees that you pay and the spread on that initial entry and exit that you pay as well. For basis trades, you must understand where your profit comes from. If you don't understand where your profit comes from, I don't think you could be conducting these trades at all, or should be conducting these trades at all. So let's go through that. The funding rate is basically a mechanism that exists to keep the price of the spot product and the perpetual product or the futures product in line. If you're unsure what exactly the spot product and the perpetual products are, let's go through that quickly, and then we'll go back to our funding rate and understand that. So the spot product is, taking Bitcoin for an example, it's the real Bitcoin. You can store it on your ledger, send to your friends, family. Typically, spot is just something that you hold, and it's the real product. If it was a spot gold, you'd be holding gold bars. The derivative product is just a derivative of that spot product. So it tracks the price. You can use higher leverage. It is only specific to that exchange, and it's essentially a contract between you and whoever you're taking that trade with. you're saying, okay, I'm trading the price of Bitcoin. It's not the real Bitcoin, but I can also make money if Bitcoin goes up or it goes down, but it's not the real thing. I can't go and send a derivatives contract to my friend. I can't store it on a ledger. It's not the real thing. So that's the difference between the two products. Going back to the funding rate, the spot product and the derivatives product should be trading at a similar price most of the time. And that's why this funding rate exists on perpetual contracts. So the funding rate is difference between the spot product, if you look at the blue line here, and the red line is the perp product or the derivative product. So the funding is what lies in between those two lines. If they venture away from each other, if there becomes a divergence between the two prices, the funding increases. If the divergence between the two prices is not there, there won't be much funding for us to take advantage of. So the funding is the source of our profit. If there's no funding, there's no basis trade. But when there's high funding, that's when we take advantage of these basis trades. Like I said, it exists to keep the price of the spot and the derivative products in line. And it's the premium that one side is happy to pay to be in a position which we can capture. So if the market's really bullish and people think price is going to go up, perp or the derivative contract will often trade above what the spot price is. And that opens up a positive funding rate. We can extract that funding rate just by jumping in a position in a basis trade where the bulls who are happy to pay that premium to be in the perpetual product. And our function in this whole scenario is to arbitrage or get the price back in line with that spot product, because they should be trading, basically 1-to-1. And the market has this funding rate to try and incentivize people to jump in, get paid a funding rate, and bring the prices back into line on these two products. The funding rate can be positive or negative depending on how traders are thinking about the market. If they're really bearish on the market, you might have a negative funding rate where the perp is trading below the spot price. Or if they're really bullish the market, like I just said, you'll have the perp trading above the spot price typically. So in any basis trade, whether it be a reverse basis or a traditional basis, who is paying us? We should understand this as well as understanding the funding rate. If you don't quite understand the funding rate, don't get to this part. Go back and learn more about the funding rate. But here, when the funding rate is positive, the bulls who are happy to, they're optimistic on price, they think price is going to go up, they're happy to pay a premium to just be in a long position because, of course, they think they're going to make money when price goes up. And we take advantage of a positive funding rate. And when bears are thinking that price is going to go down and they're more aggressive than the bulls, the perp could trade below the spot price, and then we have a negative funding rate. At that point in time, the bears are happy to pay a premium to be short because they think the market's going to go down. So that's when a negative funding rate presents itself, and we can take advantage of that also. So how exactly do you take advantage of these funding rates, and what shape and form does that trade take? Well, you've got a reverse basis trade and you've got a regular basis trade. Now let's look at a regular basis trade first. A regular basis trade is a scenario where the perpetual contract is trading above the spot price, and that gives us that positive funding rate. So a regular basis trade has a positive funding rate. If we go back up to our diagram here, and bulls are paying. So bulls are paying in a regular basis trade. We are taking advantage of higher perpetual contract prices compared to the spot price, and our funding is the difference between the two. So what we do in that situation is we short the perpetual contract. That gives us our short position where we profit if the market goes down. At the same time, we're longing in the spot. So we're short, we've got a short position, but then we long the spot. The spot, we don't pay fees other than entering and exiting that trade, and maybe a bit of a spread on entering. If we've got a different that we get into the perp at versus the spot, there's a bit of a spread there. We pay that and the fees. But the important thing is that this long position creates what's called a delta neutral position, where we're not exposed to the market direction. We've got a long position and we've got a short position as well. And on top of this, we're collecting the premium from the perp, which bulls are happy to pay because they think the market is going to go up. And at times this can be 10, 20, 30, 40%. Sometimes on altcoins you can get up to 100 or 200% if you can catch the move. A reverse basis trade is exactly the opposite of that. So we're shorting the spot product, we're borrowing it on margin, which will pay a borrow fee depending on how in demand that borrow is, could be higher or lower. And then we're longing the perp because the perp is trading below the spot. We've got a negative funding rate like up here where the bears are paying us the money to be long. These positions allow us to not have exposure to direction of the market, but instead just collect the premium that these traders who are being more aggressive are willing to pay because they think the market is going to go in a certain direction. So just to visualize the reverse basis trade, we've got the spot trading above the perp, and our profit is that funding that lies between each of those, and that translates to the funding rate, which we're taking advantage of. And the same can be said for a regular basis, except it's just the inverse. So we've got the perp trading above the spot, and our profit is the difference between the two contracts, which we're acting on the market to bring them back in line. And that's what the market is incentivizing us to do with the funding rate. That's why it exists in the first place. And to understand the incentive that this funding rate mechanism brings to the market is basically this here. So as the perp and the spot spread, the difference between the two products in terms of price increases, the trader incentive to act and to come into the market and arbitrage that rate out of the market, bringing the products back in line, increases. So that's all we're doing here. A higher funding rate equals a higher incentive for traders to step in and perform these type of trades. One thing that we need to be aware of when conducting these trades is the cost. So the cost of these trades to get in and out is what eats into our profit most. So we want to have a trade that has a strong stability in terms of that funding rates that's been paid over the previous 7 to 30 days. Basis markets is one product that we've been working on through the bear market to visualize these trades, and now to execute these trades with basically no manual execution, all auto execution, but I'll go through that in just a moment. So if we're looking at APR stability, what we want to see, if you've got funding on the left and time on the bottom, is we want to see the funding rate above zero or below zero, depending on if you're in a reverse or regular basis trade. If you're in a regular basis trade, for example, let's take that. You want to see something like this, just, moving steadily over time and trending sideways, because of course that means that over time you're expecting that this stability of the funding that's paid on the position is going to be there. It's not going to be up, down, sideways, and constantly making you think, should I be in this position, because the funding is changing every couple of hours. So on a 7-day, 30-day, 3-day, whatever your horizon is for these trades, you want to be looking at some sideways stability and overall staying quite stable, to put it for the lack of a better word. 3-day might be a little bit more erratic based on how the market is moving, but you want to see stable APRs, stable funding rates to get into these trades, because of course if you're getting in, getting out, getting back in, getting out, you're going to be paying more fees and paying more of a spread on these positions, and that's going to eat into your overall portfolio performance and the profit that you make conducting basis trades. Another good way to look at it is the open interest weighted funding rate overall in the market. This is Ethereum. Over the last 6 months, we've seen persistently green funding, and this presents a great opportunity for basis trades, because over those 6 months, you could have just held an Ethereum basis trade, a regular basis trade, and been paid to capture that premium that bulls were happy to pay over this time frame. Of course, price has gone up quite considerably. The market is quite hot. People are optimistic that prices are going higher, so they're happy to pay a premium to be in Ethereum longs on the perp products. And that's where we get this premium from. So capturing these opportunities is, I guess, the essence of a basis trade. And for 6 months, you could have been paid not being exposed to direction on the market and just capturing that premium. Here's what we've been building throughout the bear. This is a platform where basis trades are automated for you. The opportunities are presented. All you have to do is click and the execution is done for you. You're in the basis trade. All that's left to do is just monitor that, monitor the APR stability, and capture that premium that exists in the market. So you'll hear more about this over the coming months as we go to a public launch. In the meantime, you can monitor these APRs, monitor these basis trade opportunities for yourself, and capture, diversify your portfolio out while the market's hot, and capture the premiums that do exist at the moment, because there's quite a lot of opportunity in this crypto market right now. The principles that come from this video and applying it to crypto can also be applied to the traditional market. It's a little bit harder because those markets are so much more efficient than we see in crypto, but it does exist. So if you look hard enough, you'll find opportunities, no doubt. Hopefully this was insightful. Please leave a like on the video, subscribe to the channel, check out basis markets in the video description, and you'll hear more, like I said, over the coming months. And I look forward to catching you on those videos.